Well, global stocks have edged up in a week packed with earnings and a trio of central bank meetings that could see the United States and the UK open the door to interest rate cuts. Japan might lift borrowing costs in a step towards normality. Also due this week are the US jobs report for July, closely watched surveys on US and global manufacturing. After a benign June inflation report, markets are wagering the Federal Reserve will lay the groundwork for a September rate cut at its policy meeting on Wednesday. Meanwhile, around 40% of the S&P 500 by market value will report this week, including tech darlings Microsoft, Apple, Amazon.com, Facebook parent Meta platforms. And then expectations are high, so any kind of disappointment will test the mega cap sky-high valuations. When we look at the all-share index, that's up 0.4%. Financials are currently trading flat. Industrials up 0.5%, with the resources up 0.3%. Looking at the currency picture, the rand is trading at 18.34 to the dollar, 19.87 to the euro, and 23 rand 53 to the pound. To give us a little bit more detail on the market performance, we are joined by Roy Mutuni, who is a portfolio manager at Sanlam Investments. Roy, thank you so much for your time. As I mentioned in my intro, there's a lot going on this week, and with that, you're seeing green on our local markets. So what's driving that?
So it's a very interesting week because we're going to hear from the Fed, we're going to hear from the BOE, and also from Japan. And what investors are looking for here is hints as to whether September is live, or from the Fed's perspective, even this week. I guess the probability for this week is very low, but what we want to hear is that interest rates are coming down. And the reason for that is the growth picture is also softening. And one of the things that the market doesn't want to hear is that growth softens so aggressively that interest rates have to be cut incredibly aggressively to try and head off a recession. So that's what I think the market's going to be focused on this week, between what those central banks say and what the non-farm payrolls comes out with on Friday, because that's a big indicator as to what the Fed can and can't do.
If we do get a September rate cut, what kind of rate cut are you expecting? Are you expecting a preventative rate cut, i.e. we're stepping in before something goes wrong, or are you expecting a reactive rate cut, that is, we're stepping in because there's true weakness in the economy?
So the way the stats are going now is that the US economy is still healthy. There is a little bit of weakness being seen on the sides around consumer credit, maybe a little bit on real estate, but nothing that's really concerning. But it is slowing, which is what you'd expect after the aggressive rate hiking cycle we've just come from. What the Fed's trying to do is to finesse it to the point where you start cutting at the point when you can start a new cycle. So you inject a little bit of liquidity, growth comes back, and the neutral rate, and then interest rates match the neutral rate relatively quickly. We won't know for some time. Remember, you typically find out about recessions long after they've started. And that's the problem here, because they may start cutting. Remember, it takes time for the impact of interest rate cuts to filter into the economy. But that said, the economy has its own momentum. So if it's too late, we'll only know once we started seeing the big macro picture deteriorating quite aggressively, and only then can you call it reactive. As we stand right now, they seem relatively confident in the growth picture and in the inflation picture as well, but they've definitely shifted from being ultra hawkish to considering the dovish picture.
I mentioned in my intro that we've got 4 of the magnificent 7 companies reporting this week. What are you looking for?
So that's an interesting one, because typically what you'd be looking for is by how much will they beat expectations, or how big the numbers are. But then last week when we got results from Google, the question then, or rather the comment that came out then was very interesting, where they were saying this whole investment into AI is not necessarily bearing fruit over the short term. So investors start asking, for all the investment that's been made, if you can't see a benefit right now, when will you ever see it? So that I think is what investors are going to look out for when you speak up, when you see the results from these Magnificent Seven. Does anyone come out and go on the front foot and say, yes, we're seeing benefits, yes, it's a component of profits, and we'll continue investing because we can see returns coming out in the foreseeable future? That I think is the main thing. What we've been seeing with regards to results up until now is that companies have been beating, but not by as much as they typically do. So obviously the risk of earnings disappointment exists, but I think that question around the returns from AI will probably be the biggest in investors' minds as we go through this week.
If you had to de-risk from the Magnificent Seven, where would you be looking to go?
So you can't run away from the Magnificent Seven. Up until now, they've been the only source of growth. Why? Because interest rates have been very high. Mid and small cap companies tend to be higher leveraged, so paying a lot in interest and not having the turnover growth. What we're hoping for now is that interest rates come down, and in this new cycle, those small and medium cap companies start rallying. But that said, if these guys continue, the Magnificent Seven continue, even with growth at, I don't know, close to where they are right now, they still remain very attractive. So one solution I've seen a couple of commentators offering is maybe you should go into equal weighted indices. Maybe you should go into more broadly diversified portfolios where you still keep a little bit from the Magnificent Seven, but you continue increasing your exposure to the balance of the economy and also a level of defensiveness, because who knows where we go to, who knows whether they're able to land this ship as accurately as they want to.
All right, Roy, let's leave it there. Thank you so much for your time. That is Roy Mutuni from Sanlam Investments. And I mentioned that tomorrow we're expecting earnings from Microsoft, and this is going to be their fourth quarter earnings that they will be reporting. So far, when we look at the month, the share price is down 6%, but year to date, it's up 10%. So what the market is going to be paying attention to is the Azure cloud platform and any kind of new initiatives they have when it comes to the AI side of things. Apart from the fact that we're looking for, market valuation, we're trying to figure out whether the valuations we're seeing for a lot of these tech stocks, do they translate to the earnings that we're getting put forward here? So that is what we're going to be paying attention to. So the bar is quite high.